This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to this week's episode of the AJ Bell Money and Markets podcast. I'm Danni Hewson, and amongst the big stories this week, could Google be broken up? That is something that is being considered by the US government. Joining me to discuss that and a whole host of other markets news is our head of investment analysis, Laith Khalaf. Hi, Laith.
Yeah, hi, Danny. And yes, that Google bombshell sent shares in the parent company Alphabet sliding. But of course, the company has already said it's going to fight all the way to the US Supreme Court. So any breakup isn't going to happen anytime soon, if at all. A bit close to home, we're also going to be looking at an accounting issue at the housebuilder Vistry that sent its shares tumbling. And as the budget draws ever closer, we'll be discussing some of the speculation about what might hop out of the Chancellor's hat.
We also hear from Ryan Hughes, Managing Director, AJ Bell Investments, about why the United States has been the worst performing market for UK investors over the last quarter, plus how the race to the White House is being priced in by markets.
And you'll be very happy about this, Danny. Plenty more pensions talk too. There's been a boom in annuity sales. We'll be looking at what's been driving that. And Dan Coatsworth is going to host our latest Pensions Corner with the head of public policy at AJ Bell, Rachel Vey. And this one's going to be all about limits on paying in excess income once you've started to draw your pension.
Do you know, we've had a couple of events recently, Laith, talking to AJ Bell investors and some of our Money Matters campaign, the ones that are part of our newsletter, and they all want to talk pensions.
Doesn't surprise me, Danny. It's a hot topic, always has been. But let's park pensions for the moment. Let's put them in the corner just for the moment. Let's start on Google. So it's Google, once again, versus the Department of Justice. What's been going on?
Yeah, I mean, the headlines were pretty eye-popping, weren't they? I mean, Google threatened with being broken up. US plots breakup of Google. This came about because of a filing from the United States Department of Justice late on Tuesday night. So I woke up to it early hours of Wednesday morning. We kind of knew that this was coming because these so-called remedies were published after a landmark court ruling in August, which found that Google illegally crushed competition in online search. And the US government's accusing Google of calling, and I love this, pernicious harm to Americans. It's that the company has used, it's a great word, isn't it? Pernicious.
Great phrase, yeah.
Yeah, the company had used other products like Chrome browser and the Android operating system to effectively funnel its users to its search engine, preventing competitors from getting a foothold for over a decade. And, you know, if you think about it, when you're talking about searching for something, it's a verb, isn't it? I'll Google it. It has just become ingrained in our everyday life. And if you look at the percentage, it accounts for 90% of online searches. And of course, that then helps the company make money by selling adverts. Of course, now some of the remedies being looked at would prevent Google from using things like Chrome, Play, its App Store, and Android to advantage Google's search. Others would block Google from paying other tech firms, for example, Apple, to have the search engine pre-installed or set as the default option on new devices. Now, Department of Justice spokesperson said that fully remedying these harms requires not only ending Google's control of distribution today, but also ensuring Google cannot control distribution tomorrow. The next step from them, the Department for Justice will file a more detailed set of proposals on November 20th.
Okay, thanks for that, Danny. I mean, presumably Google is going to fight this.
Oh, yeah, it's come out swinging. So Leanne Mulholland, the company's vice president of regulatory affairs, that's a great title, said that radical changes that have been proposed went too far and accused the US government of a sweeping agenda that will impact numerous industries and products, talking about the risk hurting consumers, businesses, and developers, and also potentially impact the privacy and security of users and hamper the development of things like AI, of course, a huge buzzword at the moment. So, of course, it can put forward its own remedies by the 20th of December, but it did highlight that this was just one step in what will be a long, long fight. And it was interesting that although Alphabet, Google's parent company, shares did fall, they only fell about 2%. And while I was saying that this could potentially be a massive, the biggest ever antitrust victory for the Department of Justice, do you remember it's not that long ago that a judge ordered the breakup of Microsoft? Well, I say not that long ago, 24 years ago, not that long in my life, but for some people it will be huge. But of course that was overturned on appeal a year later. So it's certainly something to keep an eye on.
Yeah, very difficult to break those big companies up. But let's stay stateside for the moment. Let's quickly touch on Pepsi. It's had another disappointing set of results, Danni.
Yeah, and it was quite interesting to note that when we got those results, Pepsi's stock was actually up a touch, 2%, but still it was because the market really had already priced in the expectation that American consumers in particular have been hit by cost of living and they're cutting back on snacks. But also what's been really interesting, so when you look at the numbers, it's said that it's revising its sales outlook. Its sales really lagged expectation in the third quarter, and now it's expecting single low-digit organic revenue growth below the expected 4% that we had previously priced in. Now, what was interesting is the amount of coverage that was given to shifting consumer tastes. I don't know. Do you snack? Do you eat things like crisps?
Not a massive snacker, no. I'm not really crisps. Nuts are my real kind of problem, actually. Pistachios in particular.
Well, a lot of consumers who maybe in the past would have bought a sandwich and then bought a packet of crisps to go alongside it and a soft drink, they, first of all, for financial reasons, they're just buying the sandwich and maybe having a glass of tap water. But also for health reasons, they are now thinking about a snack that maybe isn't ultra processed, isn't ultra high fat. And certainly we had Pepsi talking about the fact that they are really focusing in on those new kind of snacks, on making sure that they've got positive choices. So alternative brands like Sun Chips and Popcorners, they're some of the things that they are looking at. They've also done pretty well at really making sure that they've sort of doubled down on the whole structure of the business. So they've really cut costs. And, of course, something that we've had a lot of coverage about, which is shrinkflation, which is giving consumers the product that they want at the price they want to pay by changing the packaging. So they've done a lot of work on that, but clearly it is something that is of significant importance for a company like Pepsi. I should also just mention, of course, that it had some big issues with its Quaker Foods brand. They had a salmonella issue back at the start of the year, and they finally closed down the company that was involved in producing that product for them. So that's also had a knock-on. But it's just a fascinating time for companies like Pepsi, and certainly having to do quite a bit of work now.
Yeah, some shifting sands there, it sounds. But close to home, we've also got shares in the house builder Vistry have tanked over the last few days. Bring us up to speed with what's been going on there, Danni.
Yeah, it had this disastrous profit warning, and we saw, as you say, shares tank. I mean, down more than a third upon this news, wiping about £1 billion off its market cap. The shares have recovered a bit, but just looking this morning before market open, they're still down almost 26% on where they were on Monday, so before we got this news. So what it said is that there's been an extraordinary number of cost overruns at a number of its sites. And it says that it's become aware that costs of completing 9 major schemes in the south of England have been understated by around 10%. I mean, that is a lot of money. So it's
not what you want to hear as an investor, is it? No. Absolutely not.
Not really, not at all. I mean, house building, I think a lot of people have sort of dipped their toes back into it over the past year or so because of the expectation, first of all, that we would see a change of government, which we've had, and that Labour government would really focus on house building and sort of house building targets. And of course, add to all of that the expectation, which did become a reality, that the Bank of England would start to lower interest rates. But when you're talking about a reduction of expected profits by around £80 million in the current financial year, and then 30 the following year and 5 million in the year after that, you can understand why there has been a serious shift in the value of shares. Now, the chief executive have said that they believe the issues are confined to the South Division and changes to the management team in the division are underway. So there's going to be an independent review as well to sort of take a look into this. But yeah, red lights flashing.
Yeah, reading between the lines, I'm thinking heads will roll there, but maybe we'll see exactly which heads in due course. So thanks very much for that market update, Danni. Now we're going to look at the US. Again, US markets is hitting a series of record highs over the last quarter. That's driven by falling inflation, and many kind of thinking that the Fed is going to cut interest rates more aggressively, and obviously the continued dominance of big tech at all. But that boom in US shares hasn't really translated into gains for UK investors. Danni, you caught up with AJ Bell's Managing Director of Investments, Ryan Hughes, to find out why the US was actually the worst market for UK investors in Q3. And we'll also be looking at how investors are pricing in a change in US president in only a few months' time.
Ryan, thanks for joining us. I want to start with US markets, always popular, and we've seen records broken again and again on US indices, even in the third quarter. And yet for UK investors, you're saying it's not been a particularly great period. What do you mean by that, and why?
Yeah, I mean, it's a really been an interesting quarter for a UK investor, because it's a reminder that there are multiple things in play when you're looking at stock markets. You've got the performance of the underlying companies, those US companies, which, as you rightly said, have performed strongly over the quarter. Markets have been going up. Everything looks like it's absolutely fine. Yet when you're a UK investor, when you turn that stock market performance back into a return in pounds sterling, it's actually been not quite as good, and that's all to do with the currency movement there. So actually, if you're a UK investor, the US stock market has been the worst performing region out of the major regions over the whole quarter there. In fact, the currency movement alone cost you 5% as a UK investor. So the market was up 5%. But actually, for a UK investor, it was largely flat over the period, and that's all to do with the strengthening of sterling versus the US dollar.
See, that is a really interesting quirk that I think a lot of investors probably don't see. They hear these stories about, the NASDAQ breaking records, the S&P 500 hitting record highs, and they think that's where my money should be. But they've got to consider more than just the individual stocks.
Yeah, you do. And to be honest, that's even true if you're a UK investor investing in UK companies that make their profits overseas, to add in another complexity to it. So, yeah, the currency element of the decision is really difficult. It's very, very challenging to try and predict what currency markets will do. But in this instance, you cannot separate the stock market and what it's doing from where interest rate expectations are and what central banks are telling us about the direction of interest rates. And so the currency movements right now are all to do with where investors think interest rates will settle and where inflation will settle. And that is having an impact on the underlying share price returns of these overseas companies. And that's true whether we were talking in the US or Japan or Asia. These different currency movements will always impact your investment. Sometimes they'll help you, but on other occasions they will hurt you. And in the US, it's just one of those quarters where currency has proved to be a strong headwind.
Is that likely to continue? Because for UK investors, you know, some of these US companies, the Magnificent Seven I'm thinking about, they get a huge amount of media attention. As we're getting the next earnings update, there might be investors out there that are thinking, okay, I'd like to invest in US companies. So what should they be thinking about?
Yeah, and this comes back to the point around inflation and interest rates, because that's what's going to be driving the currency movement. So in the US, we've seen the first interest rate cut since the start of the pandemic, actually. So it's been a good long while since we've had that. And also we've got inflation and a relatively strong economy in the US. But we've also in the UK got an expectation that inflation might be a little bit stickier than people thought. Much to do with perhaps the Labour government opening spending taps and people thinking that will actually stoke inflation or keep interest rates high. So what I think we're seeing here is an expectation that UK interest rates may be a little bit higher for longer than people had thought, certainly relative to the US. And as such, the sterling against the US dollar will likely strengthen. That's the view in the market, and therefore that will provide a further headwind if you're investing in US companies as a UK investor.
Now, this year of any year, politics has played a huge part in market sentiment, and we've got arguably the most important election still to come. That sort of race to the White House, what are markets looking at?
Yeah, I mean, it feels like it's too tight to call, although perhaps where you're getting a little bit of insight now is from the betting market, not from the stock market. When people's money really matters, to coin the phrase, what the betting markets are telling us right now is that Donald Trump is just inching ahead. And that's slightly different to what the polls are telling us. There. And often we've seen this in the UK election, the betting market's been a better guide to what's going on than the polling market, because maybe some people don't necessarily tell the truth to a pollster for a whole variety of different reasons. And so the market is watching every single little piece of information right now to try and get a steer as to what it means for the economy, what it means for the world, what it means for currencies, taxation, all these things that governments touch. And the reality is it's on a knife edge. We don't know which way it's going to go. And clearly both main candidates, have very different policies. And so the outcome for investors could be very, very different. But I'm not a brave enough man to sit here and tell you which way I think it's going to go. Many a fool has been made trying to predict politics, and particularly when you commingle politics and investments. I've been doing this for 25 years, and yeah, I think I've probably been left with egg on my face enough times not to try and predict this one.
Yeah, it's a hard one to predict. I think the only prediction I've heard that I've sort of thought, okay, maybe I get that, is that we might not have a clear idea of who actually the winner is for days, even weeks after. So expectation that there could be some volatility even in the final outcome. When we're talking about diplomacy, politics, what happens with the White House, obviously it does play into those geopolitical issues and tensions in the Middle East. That is something that market watchers are really concerned about as we're putting this out, recording this. So we've seen the oil price rise, but not by as much as many market watchers might have thought. So what should people think about that?
Yeah, I mean, the old adage that definitely the first sign of any kind of conflict in the Middle East would see a huge spike in the oil price seems to have broken down. And a lot of that is to do with the fact that the US is largely self-sufficient for its oil from its own production now, and actually at times has been a net exporter there. So if you've got the largest economy in the world that is not reliant on importing oil from a war zone, then I think that should and is giving global markets some confidence and providing a little bit of stability around it. But yeah, you've seen the oil price up less than 10% as tensions have escalated in the Middle East. So I think you're right. We would normally have expected to see that to a greater degree. Going back to currency, we did actually see quite a strong move in the US dollar around the same time as well. And that's typically seen as a safe haven currency. So people want to buy dollars in the times of trouble. And actually the gold price is another one people would look at and say maybe we would see the gold price spike sharply. Well, it's already gone up a lot before these events for other regions, largely around inflation. So there was a small rally in the gold price, but not as much as, again, people might have expected to see. So, yeah, it is difficult. It comes back to the difficulty of trying to second guess economics and politics together, because these asset classes aren't necessarily reacting in the way that the textbook and history might have led us to believe that they would.
While we're looking further afield, I can't let you go without talking about China, because I think investors have been waiting for China to do something, to pick itself up, to give the consumer a boost. We've seen sectors like automakers and the luxury goods sector really struggling. This is, Western companies that try to export goods to China. It had a bit of a boost. There's been a lot of expectation that maybe things are changing. So what's going on? And will that sort of forward momentum continue in the fourth quarter?
Yeah, a bit of a boost is a bit of an understatement. I think maybe it's 30% rally in 3 weeks for the Chinese market. It's actually closed for what they call Golden Week at the moment, at the time we're recording this, and therefore it's actually been closed for a few days. So we're not quite sure how it will react when it reopens. But the Chinese government has put a rocket under the Chinese stock market, really by announcing a whole raft of stimulus packages to try and boost the economy, to try and boost the housing market, and get the consumer buying again. And obviously for us here in the UK, a lot of that kind of story will sound familiar to us, and indeed other Western economies as well. It's what most governments have been trying at various points when perhaps their economy hits the buffers. And that's what we've seen in China over the last few years. Their economy has well and truly hit the buffers. The government here, it wants the housing market to start moving again. It wants first-time buyers to come into the market. It wants to make deposits smaller, mortgage borrowing easier. All this has got investors hugely excited in a very short period of time. Lots of foreign buyers coming back into the market. The key question is it sustainable? It's certainly got some momentum, but what anyone would want to see is that actually this is making a tangible difference in the economy. Is consumption picking up? Is economic data more positive and surprising on the upside? Until we're really seeing that, I think there's a risk that this is a little bit of a hot money rally, and we may see some of that hot money come out of the market when it reopens again. But the key is, in the long run, can we see genuine economic growth and an economic recovery? If we can, then the Chinese stock market, on a very unchallenging PE multiple of less than 10 times earnings, around that level, I'm sure for many people will think that's really an interesting valuation opportunity. But we should always remember that China is very volatile. The government meddles with the economy in many, many different ways, and it won't be for the faint-hearted. It'll be a little bit of a bumpy ride, as has proven to be the last few years.
As we wind things up, let's bring things back closer to home, because everything you were just saying there about what we want from the Chinese economy, obviously we want the same from the UK economy. We want a confident consumer. We want growth. We've got a hugely important quarter now for retailers, for hospitality. What do you think investors should be looking out for? Are there any potential, issues that we should be watching?
Well, I'll certainly be doing my bit for hospitality over the next quarter. I'm going to do my bit to help the UK economy. But you're right. I mean, we're in this crucial period, Christmas footfall and all of those things. I mean, my social media is covered with retailers showing sales 50% off now and all those things. So clearly, it is still difficult out there. And I think that what we'll be looking for as investors is poring over every single bit of economic data to try and give us a sense as to what it's like. Now, clearly, the government the last maybe 8 weeks seems like it's been not the most positive, shall we say, on the UK economy and trying to kind of predict telling us what's going to be in the budget. And I think that's probably taken the wind out of people's sails a little bit in terms of confidence in consumer spending and those types of things. So I think, we'll need to see some stabilization of the numbers. We'll look at everyone. I think, again, you'll see the stock market and the currency and the bond market react to each piece of data. And I think don't expect it to be a smooth ride as we go into Q4. Q4 historically in the stock market has been a pretty bumpy time when we look back over many years.
And last one, quick prediction from you. AI has been this year's hot story. Is it going to continue to be the talking point, the thing that everyone wants to invest in 2025?
Oh, I mean, that's a big call to say. Is it going to carry on that much? Let's think more generally. It's not going away as a topic. We're only in the foothills of the AI revolution, really. So there's so much more that's going to come from it. What, as investors, should be thinking about now is, can these companies deliver on their expectations? The share prices have gone up a lot. The expectation for their growth numbers and their profit numbers and their earning numbers are now sky high. They have to deliver on that through 2025 to keep justifying those very high valuations. If they do, I'm sure AI stocks will continue to do very well. But they're priced at such a high level that if there's any sign of a wobble, don't be surprised if you see a reasonably sized sell-off in some of these stocks in very short order, because the valuations have really gone sky high over the last year.
Some more volatility to come, Ryan?
Plenty, I'm afraid, I suspect.
Thanks so much for chatting to us.
Thanks for having me.
Now, I should say that we recorded that interview on Monday, and of course, China's markets have been bouncing around all over the place after the return from holiday. And of course, playing into the volatility here in the UK is all the speculation about what will be or won't be in the Chancellor's budget. I mean, there has been a huge amount of time between the Labour government getting that landslide victory and finally delivering this budget. And I think that has been actually quite a damaging amount of time, because there's been a huge amount of space for speculation, and speculate the papers have. And that in turn has impacted all of us, people who have investments, who are worried about taxes, who are worried about their financial situation. So we have seen UK borrowing costs nudge up in anticipation that Rachel Reeves might relax borrowing rules. That in turn impacted swap rates. But in the midst of what we don't know, we do at least seem to have some concrete news on pensions, Laith.
Yes. Concrete is very firm substance, isn't it? And I'm not sure I go quite that far, but we definitely do have some what seem to be government sourced reports that actually they're backing off from claims that we'd seen that they were looking at reducing tax relief on pension contributions. So this is when you put money into a pension. As things stand at the moment, you get tax relief at your marginal rate. So if you're a basic rate taxpayer, that means 20%. If you're a higher rate taxpayer, that means 40%. And if you're additional rate taxpayer, that means 45%. And there had been some rumours that they were perhaps going to make that less generous. And there was a report in the Sunday Times, which seemed to source some government officials briefing the Sunday Times that basically that wasn't going to happen. And one of the big reasons, apart from the massive, uproar there would be from large parts of of Middle England is actually quite a lot of public sector workers would be affected as well, and that's obviously a key constituency for the Labour Party. So I think that's probably a little bit of good news as far as it goes. That has obviously kind of thrown a bit more of a spotlight onto where Rachel Reeves might go, particularly within the kind of pensions land, which seems to be subject to continued rumours. So, just to kind of roll through the options that she might have, and obviously none of these are necessarily going to come to pass, but one of the big pieces of speculation we've got at the moment is that she's going to adjust the amount that you can take as a tax-free lump sum from your pension. So that is currently 25%, and there's recently been a cap brought in on that, and there's suggestions that she might actually reduce that cap quite significantly. There are some stories around saying that people are actually withdrawing money from pensions as a result of that in advance of the budget. I'm not sure how to feel about that, because actually they might be doing themselves a disservice by doing that, and obviously it might not happen. And the other thing to realise about it is it would be it's possible, but it's very kind of unthinkable that they would say this applies to everything that you've built up so far. And the reason I say that is because people have been contributing to pensions for decades on the basis that they will get a 25% tax-free lump sum. And so to whip that rug away right at the very last moment, just before they retire, and say, well, actually, you're not going to get that. You're going to have to start paying tax. That would be a really massive blow, I think, to pension confidence. And certainly when we've seen chancellors do this sort of thing before, where they brought in more kind of punitive rules, for instance, what used to be the lifetime allowance, we've also seen them introduce protection for people who've built up pensions. And so it only applies to money that you build up from now on, which is obviously less of a hit for everybody. They can plan, years into the future. Less money for Rachel Reeves if she takes that approach. But just saying that actually all that money you built up in pensions, we're suddenly going to tax it. It just, like I say, it's possible given the fiscal hole that we've heard about, but it does seem slightly unlikely to me. And the other things that seem to be doing the rounds are that potentially she's going to add to the kind of the national insurance that employers pay on pensions. And that is potentially, you could see why that might work, because employers are saying, well, if you do that, we'll cut our pension contributions. But the Chancellor can say, well, I didn't actually cut the pension contributions. You decided to do that. I just put up the national insurance. So you can kind of see how that will work. And I don't know if you saw the other day, Danny, but there were the questions that PMQ's Keir Starmer was, kind of dodging issues about whether national insurance on employers was going to go up, as you might expect him to do in that forum. But I think that's just also helped to get those kind of rumours swirling as well. So overall, still a few sort of things that I think people probably are worried about, but probably some good news on the tax relief, I think. But of course, all still to play for in a couple of weeks' time.
Yeah, really interesting what you say about that tax-free lump sum. You think it's incredibly unlikely, and certainly discussions that I've been having over the past couple of days, most people think that are sort of working within this sphere, journalists, that it is incredibly unlikely because, if you think about it, we're trying to persuade people to put more into their pensions. And of course, if you pull the rug out from under them when they're going and doing exactly what they've been asked to do, it just doesn't make sense at all. But also the headlines, a lot of the time, if you're just looking at the headlines and you're not clicking through to the story, sometimes that can be a real scary thing. Because I saw one the other day which said, Starmer refuses to rule out national insurance increase. And of course, you've got people just thinking, oh, my national insurance is going to go up. So it's a funny one, isn't it?
Yeah, absolutely. And the other thing about tax-free cash, again, a lot of the public sector would be affected because people build up lifetime pensions in the public sector, and those are defined benefit pensions, and so you can get some quite chunky defined benefit lump sum entitlements within the public sector, particularly amongst higher earners. And so again, that wouldn't be particularly palatable from their point of view, I suspect.
What about people who are looking at annuities? Because we've had the latest figures showing that there has been a boom in annuity sales. What's driving that, and is it likely to continue?
Yeah, absolutely. So, yeah, an annuity sales boom, and not something that you hear about every day, I'm sure, but actually we've seen annuity sales data from the FCA showing that in the last tax year, 23-24, annuity sales rose by almost 40%. So that's actually quite a big shift in people saying, I want to buy an annuity. And the big driver of that change is that annuity rates have gone up quite significantly. So annuity rates are linked to interest rates. Annuities are backed by bonds mainly. And so the yields on those bonds informs what rate you can get from an annuity, what the insurance company will give you in exchange for your pension pot. And now, the rates vary depending on various factors, the main one being your age. But if you are a 65-year-old, a kind of level annuity, which stays the same throughout your life, will now get you £7,200 of annual income for every £100,000 of pension pot that you hand over. So that's probably appealing to some people, particularly I think when you compare to where we were, when interest rates were really low. At one stage, we were talking about you'd hand over £100,000 and you get less than £5,000 annual income from an annuity. So there's been a big jump in the amount of income you can get. So that's really kind of been behind the rise in annuity sales. I think it's still important to point out that annuities are very much now the poor cousins of the retirement market, because the kind of number of pensions that are being accessed in that way is still only around 10%. And that's really been the case ever since the pension freedoms were introduced in 2015. Prior to that, around 90% of people, when they retired, took an annuity, and that's because the other options weren't particularly flexible. Then in 2015, George Osborne just totally changed the system, said, well, you can have access to your pension however you want. And so that's meant more flexible options like keeping it invested and drawing the money out, or some people just drawing all the money out, are now more popular. And so annuities still only taking up around 10% of the retirement market. And, given the kind of annuity rates are probably going to stay around this level, will probably dip a little bit. You wouldn't expect that to really change significantly, certainly not heading in an upward direction, because certainly my experience is people don't like annuities generally, because you hand over your money, it's very inflexible. You're then getting an annual income. And if you get run over by a bus the next day, well, that's your pension pot gone. And people much prefer to have, I think, control over their pension rather than handing it over nowadays.
So really simple terms, just in case someone's been listening to that and thinking, I'm trying to get my mind around what an annuity is. It's effectively where you take your pension pot, you hand it over in exchange for a guarantee income for a set period of time.
That is a great way of explaining it, actually, Danny. Yeah, I mean, I struggled myself for years while dealing with annuities to understand what are they? What is the thing? What is the annuity? Because, yes, you're absolutely right. You take your pension, say £100,000, you give that to an insurance company, and they pay you an annual income for life. That's it. It's an insurance contract. And that can be, I think, genuinely very difficult to get your head around if you've covered it from a point of view of investments, because you're kind of like, well, what's the share? What's the underlying asset? The insurance company is invested in bonds, but that's nothing to do with you. You're essentially entering an insurance contract with an insurer. Here's a pot of money. Please give me an annual income for life. And there are various options that you can take along with that annual income. So you can just get one that is level for your entire life. So it pays the same amount every year, right through until the day that you die. Now, the problem with that is, of course, that over a 20 or 30-year retirement, inflation is really going to eat into that. So you can get options where you build in inflation protection, i.e., rather than paying you a level income, what the insurance company will do will pay you an inflation-linked income. Now, there's no such thing as a free lunch, is there? So if you're taking that option, the insurance company will start by paying you a lower income. So to give you an example of that, like I said, if you're a 65-year-old at the moment, a level annuity will pay you £7,200 £200 on a £100,000 lump sum. Okay. If you wanted to convert that into an inflation-linked annuity, then that would fall to around £4,500. So it's a very big jump, actually, but then you are protected from inflation. So, like I said, there are kind of other options that you can add on as well, such as a spouse's pension. But generally speaking, the more protections you build in, the lower the starting rate that you will get.
And I guess, if you only sadly live for a couple of years, then you've handed over this massive pot and you've bought this guarantee. Is there a way to make sure that you can also hand it over to your loved ones?
Well, I mean, the pot is gone, but there are protections that you can build in. So the spouse's pension is one of those that will continue after you die. So you can choose the level that continues at. So 50% spouse's pension is fairly standard, so that if you're getting £10,000 a year from your annuity and you die, it continues for your spouse's life at a rate of 50%, i.e. £5,000 for the rest of their life. You can also buy guarantees which go to a beneficiary, so for instance a 5-year guarantee or a 10-year guarantee. Again, all of these things reduce the starting income that you've got, but I think probably the appeal of keeping your money invested in what is a drawdown plan for a lot of people is that there is still a pool of assets still there, so that actually there's a lump sum rather than an income that can be passed on to a spouse or the next generation.
And you get to choose, I guess, if you need a bit more one year because you want to go on a holiday, you've got that option. Whereas if you've gone with an annuity, you've basically got to deal with how much you get every year. I guess that you can have two things running side by side.
100%, and actually that's not a bad way of going about things, because actually what an annuity provides you with is a security of retirement income, which a drawdown plan doesn't, because if you're invested in the markets, they can go up and down. Your income can go up and down from those, and obviously you can manage it sensibly and get a reasonable income stream that's sustainable. But that annuity just gives you that certainty of income, particularly if you've got it inflation linked. And having that as part of your retirement solution, I don't think is such a bad thing for you to be considering, because you don't have to choose annuity or drawdown. You can do a bit of annuity, a bit of drawdown, and kind of have the best of both worlds. So you've got a bit of flexible income that hopefully should grow over time, and you've just got that bedrock of secure income as well, which will continue until you die. And we've talked a lot about being run over by a bust, and the day after you buy an annuity, I think a lot of people discount the flip side of that risk, which is what if you're living till 100 or beyond, and if you're retiring at 60, that's 40 years. Your annuity is still paying out at that stage, and probably whether it's just kind of our pessimistic bent, but we prefer to kind of focus on the bust rather than potentially being on 100 years old. So we're worthy of consideration, like I said, because interest rates have risen, actually more appealing now than they have been for a long time.
Thank you, Laith. I bet you didn't expect to be grilled so much on annuities today, but I do know.
Now, yeah.
Well, certainly we've heard a lot from you guys that listen that you really like to get underneath the skin of things. So thank you so much for that. And talking about getting underneath the skin of things, it is time for Pensions Corner. See, we're full of pensions this week. Dan Coatsworth has been throwing your question to our head of public policy, Rachel Vay.
So, Rachel, we've had a question from Graham, who says that he and his wife are both pensioners receiving the state pension. His wife also receives a pension from the NHS. Now, they're both self-employed, earning between £5,000 and £10,000 a year each. Plus, they receive income from renting a commercial property, which is about £20,000 a year. They both got personal SIPs in drawdown after taking out the 25% tax-free, which they sometimes draw income from if needed. Graham wants to know, can he and his wife add surplus income to their existing SIPs? And if so, what's the upper limit? And also, do they have to set up new SIPs in order to do this?
Thanks, Dan. It's quite a complicated question, this one. Pensions are an extremely tax advantageous way of saving for later life. So, as you know, you get pension contributions. What the money you pay into a pension receives tax relief. And when the money's invested, you get tax-advantaged investment growth. Plus, when you come to retire, someone can take usually up to 25% of the pension pot as a tax-free lump sum. So lots of really good tax advantages. But because of that, there are rules on how much money people can put into pensions. And one of the main ones is that someone can only contribute up to 100% of their earnings and receive tax relief. Now, when we go through that rule, we tend to oversimplify and just say, oh, well, someone's income is either their employed or their self-employed earnings. But as Graham's question really shows and really demonstrates, life isn't that simple, is it? We've got money coming into our houses, into our wallets, and that comes from various sources. So it's probably a good idea just to take a step back and think about what earnings really are. So this limit, this 100% of earnings limit, it applies to something that's called relevant UK earnings, a little bit of tax jargon there. And HMRC, they give us a list of the income that falls into this definition. So as you would imagine, it covers employed earnings, including bonuses and overtime and commission. And it also covers self-employed earnings. And self-employed earnings are defined as income that is derived from carrying on a trade, a profession, or a vocation. So that's the official definition of it. And redundancy payments could also count towards your relevant UK earnings, but only the part of the payment which is above the tax-exempt threshold of £30,000.
So that counts towards relevant UK earnings. I guess the key question is, what doesn't count?
Well, pension income, whether it's going to come from a private pension or a state pension, that doesn't count towards your relevant earnings. Dividends that you receive from investments, they don't count either. And most rental income is also on the no list. There is an exception to that one. And the exception to the rental income is that it may be included if it's in respect of a UK or EEA furnished holiday lettings business. But you would really need to investigate just to make sure you knew exactly if it was included or not. Also, if you sell property and you make capital and you sell asset or other types of assets, then that's also not going to be included as relevant earnings.
So once someone's worked out what relevant earnings they may have, are there any other limits that they need to be aware of?
Right. So they have this limit on their personal contributions of 100% of their relevant earnings. But there is another big limit on the amount of money that you can put into the pension, and that's called the annual allowance. And that's set at £60,000 a year. Now, that includes your contributions going in and your employer's contributions that are going in as well. So that's an overall limit of 60,000. But there are two other annual allowances which could apply instead. Now, one of them is the money purchase annual allowance, or the MPAA, and that is set at £10,000. And that is triggered if an individual flexibly accesses their pension, which is a horrible phrase. But really what it means is that somebody has taken a taxable income through drawdown, or they have taken an ad hoc lump sum, which is also called an uncrystallised funds pension lump sum. So if they've done either of those things, generally, that's when you flexibly access your income. So, and in that case, the annual allowance goes down from 60,000 down to 10,000. There is another annual allowance. So we've got three in total, and this one is called the tapered annual allowance. And this just applies to very high earners. And again, this can reduce the 60,000 annual allowance right down to 10,000. But that depends on the individual's income level. So another key point when we're thinking about Graham in particular, because he said that he was in receipt of the state pension and private pensions as well. So another key point to make is that tax relief on pension contributions is only available up to age 75. And after that point, people in theory, you can contribute to a pension, say a SIP if you want to, but you won't receive tax relief on that contribution. So in practice, many pension providers just won't accept these contributions. And then the final point is Graham asked whether someone can pay into the same SIP account as they are drawing income from. And I'm afraid the answer to that one is it depends. It just depends on the pension provider and how they administer the pension. And some of them are going to allow it, but others might ask you to set up a new pension account.
Okay, thanks to Dan and Rachel. And don't forget, if you've got any burning pension questions that you want answered, or actually if you've got any questions more generally for the team, do email us. The email address is podcast@ajbell.co.uk. We'd also love to get any feedback and suggestions of guests or topics that you would like us to talk about.
Okay, now I have to say that I kind of agonized over what to end the podcast with, because there's been all sorts of stuff. We've had details about holiday numbers, the amount of holidays people take, and I thought that might appeal to you, apt to reckoning that 3.9 holidays are now being taken on average by Brits every year. We also had Shein overtaking Boohoo for UK sales. But when given the option, you were interested in Netflix achieving record subscriber numbers in the UK. And that is despite, this password crackdown and an increase in fee.
Yeah, and that's why I was quite interested, because it kind of struck me as a little bit odd, because it feels like there's a lot more competition around for streaming now, and exactly what you've just said is that Netflix has been getting a little bit less generous with with sharing. So yeah, really interested to hear what's behind that.
Yeah, I mean, exactly what you say. So it posted UK revenues of £1.7 billion, $2.2 billion, according to its latest company accounts. Now, we're talking about increase of revenues by 8%, a lower jump than in 2022, because that was 12%, but it still represents a record figure for the company. Now, we did see Netflix hiking prices. So the basic plan, which costs $6.99, it rose by £1 a month, and the premium plan by £2 a month to $17.99. And if you think about, everything that we're paying for, if you've got a couple of streaming services, if you've also maybe got, an original Skybox service or something like that, you can end up paying a really chunky amount just for your viewing pleasure. And I know a lot of people have gone through and got rid of streaming services and got quite clever at axing a service when they've watched everything that they want to watch, getting another service, watching everything that they want to watch there, and then flipping back to that service. Is there a particular series or film that has sort of pulled you in to watch a service?
Yes, there is. Do I need to disclose what that is?
Yes, please.
I'm slightly ashamed to say that it is the House of the Dragon, the Game of Thrones sequel. So yeah, I've actually a bit disappointed by Series 2, but it still dragged me into a now subscription.
I've not managed to watch that yet. I did watch the first 2 series of Game of Thrones and then got bored, and people keep saying, no, stick with it, because it is really worth watching. This is quite... I like house programs. When they buy a house and they repair them and do them up, and then they make loads and loads and loads of money. I can watch those just on a loop. That is my sort of go-to. Forget these.
This Danni ever.
Yeah, forget The Crown, forget anything like that. But what I did notice in the last couple of days is that a lot of people are threatening to get rid of their Netflix membership because it's not renewing certain titles. And the one that I spotted was Chaos. Have you seen that one?
Right, I watched a couple of episodes, yeah. not for me. But yeah.
Yeah, Jeff Goldblum as Zeus. I watched one, and similarly, not for me. But I just think it's fascinating to look at the way that the UK consumer is performing, and we actually get the latest global earning update from Netflix next week. So I'm sure we'll be talking about that in either next week's pod or the one after, because it does give us a real insight into consumer behaviour. But that's it for this week's episode. Laith, thanks for joining us.
Yeah, thanks for having me. Thanks everyone for listening.
And next week, Charlene Young will be here along with myself, and Dan Coatsworth will be chatting about weight loss drugs with International Biotechnology Trust. Until then, thanks so much for joining us.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.